monetary policy, fiscal policy, and supply side policy. These are just the three main policies used to control the economic activities. For some reason I ended up writing economy, but it's economic activity, output, and prices. Basically, you can mention this. Now, these policies affect the business in different ways. The fiscal policy and monetary policy are generally considered to be short-term policy tools to affect short-term fluctuations in the output and prices through their effect on aggregate demand. So the idea here is to sort of shift aggregate demand to the right or to the left from its current position. Supply side policies tend to have long-term effects, however. This could include, for example, shifting the aggregate supply to the right by training the employees, so labor force in the economy, for example, yeah? Or investing in education, investing in schools, the way kids are educated, for example, yeah? Investing in new technologies, investing in capital structure. The long-run aggregate supply curve shifts to the right. When the labor force is more educated, or you have more labor, more migrants coming into the economy. So these are the policies that governments undertake to affect the aggregate supply in the long run, which means the capacity of the economy improves or increases, so it becomes a large economy. While fiscal and monetary policy are short-term tools to correct the short-term fluctuations. We will be using fiscal and monetary policy to stabilize the economic fluctuations in the short run or short-term fluctuations in the economy, right? So here's the long-run trend of the output. So over time, real national income, which is basically an output of the economy, real output of the economy, real GDP. So this is the trajectory of our long-term growth, or this is what we expect the economy to sneak around, the output sneak around this line. And the red line is the darker red line is the actual output. So it's fluctuating from year to year, much deviation above and also below, which is basically recession. Here we have expansion, recession, expansion. So below and above in some years, over time, the economy is basically, actual economy is just fluctuating around its average value. But what we want with the fiscal policy or monetary policy is to reduce this magnitude of volatility. So you see the dashed line, that's what we want. We don't want a large deviation from the average line here. So we want to minimize this, so we want to push the curve downwards, yeah? We don't want accelerated growth and deceleration quickly. We want a gradual employment or growth in economic output gradually, but if we hit the recession, we also want them to be less sharp as well. We want it to be more controlled. In other words, yeah, this is what we will do with fiscal and monetary policies. Yeah, when we implement them, we want to sort of make sure that the red line sort of flattens downwards or is pushed downwards or pushed upwards here. This is the gross domestic product. The blue line here, the straight line, is the potential GDP. So you can see that around the blue line, red line basically fluctuates. This is the period of recent financial crisis. You can see that for the most of the period here, 2005 to 2008, actual GDP was above the potential GDP. So we were doing well. I mean, in fact, the economy was heating up. A sudden sharp drop below the line implies this is a recession. We are still below the line, but below the potential. So the economy has a potential to grow along this trajectory, but we went downwards here. So the idea was somewhere here, the economists or the US government started thinking about how they could address the drop in output. Yeah, this was inevitable. I think if I remember correctly at the time, reading newspapers, I think I was writing my dissertation. I think that was Obama government. They were thinking about reducing this large drop, so flattening it and pushing it towards the blue line. That was the idea here. So what they did, they injected 600 billion into the economy. So if they injected somewhere here, effect just took hold somewhere here after a year or so, and gradually the economy came back to its normal potential level. Monetary policy. Now, monetary policy is basically a set of actions taken by usually the central banks. The central bank is independent of government, but in some cases it's not in some countries. So central bank is so here we refer to central bank as an independent organization in the USA or also in the UK. We won't say government here. The idea here is with the monetary policy is to affect the supply of money, supply of cash, in other words, and then its cost of money. So the cost of money is interest rate, right? How much it costs basically to get a loan, it's the rate of interest. So interest rate is the cost of money. Now, supply of money is basically all the paper currency and coins placed in circulation by the central bank plus the money in your current accounts. I think in the USA you call them checkable accounts, yeah? The accounts where you store your own money for day-to-day use. So they are available basically. This is the current account is readily available, yeah, to spend money in your current account. So that's why it's part of money supply. Now, money is a commodity, is a product, let's say. It has a cost, and its cost is the interest rate. It's the rate at which you borrowed the money. Now, how will the economy, so central bank, control the money supply and also affect the economy or economic activity? It's through the interest rate transmission mechanism that I'm going to describe in the next slide. So let's look at that. So monetary policy, interest rate transmission is the topic in this slide. Now let's remind ourselves what aggregate demand was. It was the sum of consumption expenditure, investment expenditure, government expenditure, and then the net exports, yeah? Exports minus imports. Now let's say that the economy is running below its potential output or maybe above its potential output. That would be interesting to look at. Above its potential output, which means economy is overheating somewhere here. It's growing faster, so we should really be close to this line, but it's growing faster. It's somewhere here. It's producing more than it usually potentially would produce. Maybe some people are working overtime temporarily, but that's risk. It's risky, basically, in other words, because when you have high inflation, so with the high growth and faster growth comes high inflation, and it usually dampens the growth eventually. So we would like to have a gradual growth. So let's say there is a high growth. Now, government is concerned that it will lead to inflationary pressures, and then things become more expensive and unaffordable, and so on and so forth. So what they do is they need to dampen the economic activity. One way to dampen the economic activity is to stop the flow of cash into the economy, to reduce the flow of cash, circulation of cash, let's say. What do? Well, they increase the interest rate. They increase the interest. So this interest rate increasing means it affects our borrowing behavior. Let's look at individuals. High rate of interest means we will be, less interested in, or we won't be interested in borrowing credit cards or opening credit cards and buying on credit cards, because this will be more expensive. Credit will be expensive as a result because it's high interest rate, credit card, for example. Or we would be very much concerned with borrowing a loan, let's say, to buy a car if the interest rates are high. If, let's say, interest rate today is 10% on a car loan, I'm prepared to borrow £10,000 to buy a used car, let's say, second-hand car. But if tomorrow government announced that, or not the government, the central bank announced that the interest rates are 20%, double the rates that I am currently thinking about, I would think twice before borrowing, because I'll be, locked into a contract with the bank for £10,000 loans. I'll be paying at 20%, let's say a minimum 20% interest payments annually. So that's a lot of money, isn't it? I'm going to pay for just getting £10,000. In other words, cost of borrowing has increased. So with the high amount of interest, I will not be borrowing, and like me, many people will not be borrowing. So we will now curtail our consumption. We restrict our consumption, limit our consumption of goods and services. So C declines, so the C goes down. So aggregate demand is affected as a result. You see how this is interest rate mechanism works. Now how does it affect firms? Now with the firms, high interest rates means fewer new loans. They will also be holding back their decisions to invest, let's say, through new loans. They may not borrow at that high interest rate. As a result, investment goes down, so that I goes down. Now, it also affects the existing loans. Some loans are indexed to the reference rate. So if the central bank increases the interest rate, it increases the cost of borrowing for the existing loans, or cost of the existing loans, I should say. So that affects the profit margin, so interest expenses will increase. Well, high cost means, well, less production as a result. The supply declines, so employment declines. As a result, unemployed people consume less, so that consumption again is affected. So essentially these two, C plus I, are affected largely. G is not, because G is independent of the policies. Usually G is also on its own is a policy tool anyway. Right, so this was the case for high interest rate. How about reducing the interest rate? It affects again our borrowing behavior. As individuals, we'll be thinking about borrowing now car loans, obtaining a car loan, because this so low a rate, I'll buy a car. Now, the reason this is done is because in the crisis, people are unemployed, they don't have enough income, their consumption usually decline. So with this low interest rate, now the government is stimulating consumption. It's just pushing this upwards. Same with firms. If the interest rates are low, firms will be able to pay their loan interest payments, and they will also obtain more interest-bearing loans, or loans from banks, which then increases investment in capital stock, which obviously increases employment in the end. So consumption, investment, and consumption again increases, affecting the aggregate demand. So that's the idea behind monetary policy. Now, how about other tools that central bank uses? So it's part of monetary policy. These are open market operations, refinance rate, and reserve requirements. These are tools that help control the supply of money in the economy. Now, with the open market operations, central bank basically will be able to pump money into the economy, pump cash into the economy. Central banks can buy bonds. Now, bonds are type of securities that are issued by central banks or governments when they needed money. For example, US government, let's say, said they will be injecting $2.2 trillion into the economy. 2.2 trillion. So I'm gonna do a bit of digression here. So the US government, they have fiscal package, this is fiscal package equal to 2.2 trillion, as long as they earn less than 75,000 per year. I think that's the best requirement. This package includes trillion. This package includes money for businesses hit by the coronavirus situation, pandemic, who lost their business, airlines, so on and so forth, So this is a huge amount of injection. Now, where does the US government get this much money? It's usually, running deficit, the government deficit. They actually don't have enough money. They don't have this 2.2 trillion. This is a short-term measure to reduce the fluctuations. We say US economy is rich. Indeed, it is a rich economy. Country is a rich country, but this is cash. Being rich is different from having that cash. You may be rich, you may have the houses, but you may be cashless rich. You may have a plane like Donald Trump, but all your business is basically business empire built on someone else's cash, right? So you're just feeding on someone's money. That's what the US economy is right now like. It will go out and then issue treasury bills, treasury bonds, and treasury notes. These are broadly bonds, the securities, I should say, debt securities. Now, US government might print some of the money, but it doesn't print all of it. It might simply borrow it, part of it from, let's say, governments, other governments, let's say China, Saudi Arabia, Russia, where the cash is basically being piled up. I'm joking, may not be. So they will borrow US treasuries, securities, in return for, let's say, 3.5% per annum interest payments, yeah? So these are depositors or creditors, while in this case, USA is the debtor. So now, this money now needs to be injected into the economy. What happens is that part of it goes directly to the businesses and individuals. Part of it could be pumped into the economy in the financial markets by, let's say, US government then could be buying, let's say, bonds back. Earlier, let's say 5 years ago, US government may have, let's say, issued treasury bond. Now it might want to buy it back, so the issue may have been for about, let's say, 1 billion. So now what happens is that US government pays back 1 billion to the holders of this security that it issued, plus the interest payments. So you see the money is now going into the economy. This 1 billion is now going into the economy. So that's the open market operation. It's a direct, outright purchase of the bond that it issued before. If it wants to reduce the cash in the economy, it could also sell the bonds. So by selling the bonds, let's say after a year or two, if we go well, and then we come out of this darkness unscathed, what happens is that the US government may buy back some of the loans. Sell some of the loans. What they call, not loans, bonds. In the financial market, within the US, for example, if they sell bonds, they actually collect the cash from individuals. Yeah, so this is the reduction in money supply. So this way they control the money supply, which affects the interest rates usually. Right, that's one way that open market operation can be used. Now, second tool is called free financing rate. It's the rate at which central banks lend to banks. So these are the commercial banks. Banks like Barclays, HSBC, and things. So they are able to borrow from central bank at this rate, at a small rate, for example. If the refinancing rate is high, the banks usually tend not to borrow, so which means they don't lend, so money supply is reduced. Also, refinancing rate also affects the lending behavior, by the way, and borrowing behavior of central bank. Yeah, commercial banks. CB here is a commercial bank. Next, it's like commercial banks are the customers of central bank, just like we are customers of commercial banks for loans. Yeah, exactly the same thing. It's just central banks don't lend to us, they lend to banks. And banks then take the money and lend to us. Yeah, that's how it goes. So how this is how it works. So this is the central bank lending to banks in the market, and banks lending us, so consumers. Yeah. Now there could also be another measure, or the tool, reserve requirement. Basically, what it does is that the government requires, let's say, 10% reserve in banks, which means if a customer puts £100 into their bank account, bank takes that amount and then keeps the 10% of it, 10%, which is £10, in its reserves, and then lends 90% of it to someone else. So basically, they take your money, pull them all, lend them out to others who need them. So you don't need the money now, so you put them in the bank account. But the banks then don't keep them. They actually use them to make, let's say, mortgages, loans to others. Yeah? But each time you put in money, they keep a certain fraction. In this case, 10%. You see, if let's say the reserve requirement is 50%, which means out of £100 you invest, £50 will be kept here in the bank, and only £50 will be given out as loan. So you see the money supply is now being affected here. So low money supply means high interest rate. So if you don't put more money into the economy, don't pump money into the economy, give to the hands of the people, then eventually they start demanding more money. So it affects the interest rates. So money supply is one tool to affect the interest rates. Right, so hopefully this is clear. It's a very short introduction, but that's how it works. Now let's look at combine together all this what we've learned to see how the money market equilibrium is achieved. Money is like a commodity. If you look at this XY plane, you have on this y-axis the price of money, which is basically interest rate, and on the x-axis here you have the quantity of money, amount of money. So this is the Q. Now money supply is usually fixed, so just once it's supplied to the economy, it's fixed usually. It's not changed by central bank that often, so we roughly fix it, let's say at this level. But the demand, money demand, is a downward sloping curve. Money demand is reflected on a downward sloping curve here. Now notice this. At high prices or high interest rates, we have less demand for money. At low interest rates, we have high demand for money. Now, interestingly, where the demand and supply curve cross, this is our equilibrium point as before. This is the equilibrium point. Now, when the interest rate is high, we have less demand than supplied here. So there's sort of surplus of money here. Can you see that? Surplus of money. So we don't want, so quantity of money demanded is lower than the supply. So this is the surplus. This is the surplus. What happened is that as a result of surplus, interest rates come down. If interest rates are below the equilibrium rate, what happens is that we demand more money. This is cheaper now, isn't it, than what's available in the market. So in the supplied by government. So there's a shortage. So this whole distance is shortage. So what happens is that interest rates then start creeping up. It's like shortage pushing up the prices, and we tend to settle here somewhere here in the equilibrium point here. Right. So that's how the money market works, and equilibrium is achieved. We'll return to this after we cover the fiscal policy. Now, fiscal policy is a tool used to influence aggregate demand or economic activity through changes in government or manipulation of government income or government expenditure. And something is missing here, taxes. Not sure why I didn't include it, but they should include taxes as well. So taxes, by the way, government income is taxes, I'm sorry. Taxes and expenditure. I'm sorry, this is taxes, I didn't realize. Now, again, AD is concerned here. We're looking at AD being consumption plus investment plus net exports. So the main idea here is to influence this so that we can shift the AD. We can reduce AD or increase it. This can be accomplished by tax policy, increasing or decreasing tax, or spending more or less through G here. So if we change the tax, usually it affects our consumption behavior. High taxes reduce our consumption or reduce investment as well. Low taxes increase and also increase this as well, yeah. And spending, obviously, we've talked about it quite often now, about COVID cases, COVID pandemic causing spending or stimulus to increase. So G basically increases by shifting the AD. So these are the two sort of policy tools. Tax policy and government spending policy are the part of fiscal policy here. Now, fiscal policy can be expansionary. It can be expansionary. In other words, when the economy is not doing well, governments usually implement expansionary fiscal policy. It could be contractionary. When the economy is doing exceptionally well, governments may want to contract the economy, or economic slow down the economic activity, because when the economy does exceptionally well, something happens in the economy that abruptly puts a stop to the fast growth. What we don't want is that we of course want the growth to be long lasting, but what we don't want it to stop abruptly. That's gonna cause sort of huge unemployment in the economy. That's what we don't want, and not economists don't want it. Now, I'll give you 3 cases to explain what contractionary and expansion policies mean. The first case is an economy A, operating at its potential output level, full employment level, which is that we covered. So this is our long-run aggregate supply curve, and we are producing that amount that's optimal for the economy. We're employing all the resources that we have. Of course, there are some unemployed people, voluntary unemployed people, yeah, that's fine. And our short-run aggregate supply and aggregate demand curves cross right here on the point here, with sort of at the potential output and then at a certain equilibrium level of price. Now, so for this economy, we don't need any stimulus. No need for intervening. We shouldn't intervene in this economy. Yeah, it's doing very well. But in economy B, government needs to intervene, because this level of output is what it needs to be producing. In this economy, this is the full output level. So I'm gonna draw another line here, another graph here, to show you what I mean. So it's important that you understand this intuitively. So this is basically our YF. This is the level of output, let's say, that we're interested in, and this is the actual output levels in the short run. So this is real GDP. Oh no, this is price level, sorry, and this is output. Oh, apologies. This is real GDP. Oh, yeah, this is time. This because I'm looking at the second graph, not this one. So I'm gonna shift this into the timeline here and say, here, since the short run aggregate supply and aggregate demand on an equilibrium, short run equilibrium, which is below the potential output, so we are somewhere here, let's say. This point here, this corresponding to that point, is YF, which is this amount here. I'm shifting this static point into this dynamic graph. This is the amount. I'm sorry, this is the amount, sorry, this is YF here. This is YF, while this point, so this is time, let's say this is 2000. While this one here, this point here is Y1, this Y1, which is this guy here. So what we want is to bring this, to move from this point to this point, somewhere here. We would like to bring the economy back to this point over time. So over time we need to do something there. So that can be done by shifting the aggregate demand, this aggregate demand here, AD curve, to the right, so that we eventually cross this point. So we move here. This is what we want, AD2. Now, to do that, we will use expansionary demand side policies, or expansionary policies, the ones that we discussed earlier. So we need to probably spend more money. That's what the governments are doing now. 2.2 trillion in the US economy, 80 billion in the UK economy, so on and so forth. Yeah. So these are the sort of policies. Cutting the taxes will improve and shifts the aggregate demand to the right, and so on and so forth. So that's an expansion policy. To come back to this point, yeah. Economy C is basically doing exceptionally well here. So in the economy C, So we are somewhere here. It's doing very well. It's basically production is now well above the potential output. So it's here. This is a large increase in output basically. So some people are working overtime. Some resources are being temporarily used, over their capacity. Factories are working above their capacity. That creates inflation. This is GDP. Now we are right here. We would like to be along this curve, close to this curve. So what we want to do is just then reduce the economic activity. So reduce the demand curve so that we can move somewhere here and then stay here. So we need to be here. So we would like to be here, somewhere here. We don't want more than what we can do. So we don't want to be in this zone. Also, we don't want to be below. So to the left, to the right. We would like to be close to this sort of red line, red vertical line. So the policies that shifts aggregate demand to the left is called contractionary demand side policies. That reduces the activity, economic activity. So that's a brief introduction to contractionary and expansionary policy. Now, as you can see, this process of policy implementation requires the government to intervene. Economies are not on their own self-adjusting. In other words, if government intervenes, it usually affects AD through G. So C plus I plus G plus NX, net export. So this is what they are trying to do. Increasing G so that C is affected, I is affected as well through, let's say, injections into the economy. Historically, economists were classical economists before the Keynesian economists started working on government's role. Basically, John Maynard Keynes, the British economist, I think he was from Cambridge, helped the US government to pull the US economy out of Great Depression. This is how we learned that we can actually affect the economic activity through G, through investment, through government intervention. Now, prior to that time, classical economists thought that the government shouldn't intervene in the economy. The economy should self-adjust where it goes into recession, or it should also self-adjust where it's overheating or doing very well. But in Great Depression, it didn't happen. That didn't happen. The Great Depression was, by its name, as you can see, was a long period of recession. And I think I gave you an example last time. It was a long period of recession. So people lost jobs. They didn't gain jobs back. Economy couldn't self-adjust. People didn't have enough money to invest. So John Maynard Keynes advised the US government to invest. So basically, said, why don't you inject money into the economy? Pay private companies to build bridges, to build factories. That creates jobs, obviously. So that way we can reduce unemployment. As a result, U.S. economy started pulling out of the recession. Eventually, by the World War II, the economy was out of recession. It was booming. This slide just describes you the difference between classical economists and Keynesians. And Keynesians prefer government intervention in the case of short-run fluctuations above and below the potential output. Again, our AD, aggregate expenditure or aggregate demand, let's call it, is this equation. We said expenditure in the economy, total expenditure, is equal to income. Remember the circle flow? You have firms, you have households. Households buy goods, firms pay income. So this is basically expenditure going into firms, and then back comes the income in money in the form of income. Now, expenditure should be equal to income, but it may, in short run, not be the case where income is not equal to expenditure. Yeah, so let's look at this first case here. Along this 45-degree line lies points where income equals expenditure. Income equals expenditure. Now, this point here, let's start with this. YF is the full employment output, just like the one we analyzed earlier. And this blue line shows us the aggregate demand. This is the aggregate demand. Now, if the economy is operating below its capacity, in other words, we are facing a recession, then we'll be operating at this point, Y1. So the crossing point here is this point here. So our aggregate demand will be characterized by this line. Now, how can we sort of bring the economy to this point, to YF? So we would like to move the economy output to this point. One way is to shift the aggregate demand from this point to this point, basically. So we have to shift it upwards. So in other words, we have to plug this something called a recessionary gap or deflationary gap. So we can we need to manipulate one of these or all of these such that it shifts towards the equilibrium aggregate demand. In a way, how to call this? We would like to move the economy to the full or potential output level by sort of injecting cash or by manipulating consumption and investment as well as G, such that the expenditure line moves upwards. Right now it's below its full potential level. Now in the second curve, we have similar situation, but the positions are reversed now. Now in this case, full potential output is this point here, is that point. But the economy is operating well above its full potential level. So in other words, we have this gap here. So that means we have an inflationary gap. So we would like to reduce the aggregate. Demand. To do that, we again we come back to aggregate demand, shifters of aggregate demand. So we will have to manipulate. So in this case, since we are operating above the potential output and we're spending more than what we are producing, in that case, what happens is that we cut back our spending. Maybe we reduce the consumption, so if taxes may be raised, cut back our expenditure and then increase the interest rate so that investment goes down. So we will then move back to the full employment level. So this gap, the inflationary gap, would be reduced or eliminated. In this case, basically, we are consuming less than what we are earning. And we could operate somewhere here rather than here along the 45-degree line. Yeah. So that's another way of analyzing the how macroeconomic policies affect the short-term fluctuations. Now, multiplier effect. What it is. So far we have said that the government tries to affect the AD, but how will the change in G work through the economy? That's what we need to work out. And how, let's say, how can we quantify this change in G and its effect on aggregate demand? So let's say we have AD. Let me put my thoughts together. CIG plus NX. So the question is, how do I know by how much aggregate demand increase? Let's say if government injects, let's say, 10 billion into the economy, dollars, yeah? we know that when G increases, it's going into the economy as sort of in the form of expenditure. So it increases the income of, let's say, employees working for, let's say, government or government commissioned projects. So these employees go on to buy using more income. They increase the income, going to buy more goods and services. So their C will increase. And with the G, I increases. You see, what happens is that aggregate demand, each of these components increasing, aggregate demand shifts to the right. So basically what happens is that if there is, let's say, there's a slide here, but I think I prefer drawing it. So this is our output price. This is our aggregate. Let's say the government uses an expansion policy to increase aggregate demand. So they put 10 billion into the economy. With the G increasing now at the given price level, G increasing now, there is a shift by 10 billion of AD to the right. Yeah, there is a shift. So that shifts the AD to the right from AD0 to AD1. Now, with that money, 10 billion in the economy, some of this money goes into the, let's say, wage payments, so wages increase. Consumption increase now in the next round, so consumption will shift the AD again. So this is the second round, AD2. Now, some of the money goes into firms and they will reinvest the money, so that increases. So it goes on, AD3 to AD3. So as you can see, eventually AD, let's say, settles right here. It expands, you know, it shifts to the right eventually. Yeah. Now the question here we would like to ask is, by how much did that AD increase after 10 billion increase in the injection in the AD, right, into the economy? So we want to know by how much that change was. What's the magnitude of that movement from this point to this point? This is what we are addressing now with the multiplier effect here. So let's see how we can do that. There's a slide here that explains exactly the same thing I've just shown you. And so here it is. You can carefully read it, but I've already showed what it is. And I'll move on to the formula here. The formula to work out by how much our AD increases is basically, or the income increases, is this one. So the effect of injections into AD depends on MPC, marginal propensity to consume. It's how much we consume out of the income we receive. So that's marginal propensity to consume. If MPC is equal to, let's say, 3/4, from every pound we receive as an income, we consume 1/3 of it. So that's 1/3 of a pound, or 3/4, I should say, not 1/3, apologies. So 75%. And what happens to 25%? Well, it could be withdrawn. Remember withdrawals? It could be our savings, taxes, and we could also consume imported goods. Yeah, 3 of these were withdrawals, remember? So this is the consumption. So this helps us to calculate the effect of injection into the economy, G. Let's say G increased by 10 billion. Now, question you might want to ask, by how much will my income increase in the whole economy, I should say. Then we will use this formula to come up with the effect of multiplier. Yeah? Right, so the larger the MPC, larger the multiplier. So here is an example. Let's say the government injects 20 billion into the economy, and MPC is about 80%, which means 4/5 of our income is basically consumed. We spend on consumption, in other words. If we receive a pound, we spend 4/5 of it, or 80p of it. Then, given the MPC, we can calculate the multiplier, the rate or the amount by which income increases after 20 billion injection. So it's 5 times. So initial spending of increases our AD or income by, so this is change, let's say put the change here, by 100 billion. Yeah, so this is billion, it's 100 billion. So that's basically equal to 5 times 20, isn't it? So initially we injected 20 billion and we multiply this by 5. This is by how much our income increases. So this is the idea behind fiscal policy. We would like to inject a small amount, 20 billion, and in the end receive 100 billion, yeah, in terms of change in income. Yeah, that's the idea here. So how do you calculate it? Here it is, if you remember. So this is 1 times basically here. Change in government purchases, let's say G here, G increased by 20 billion. This is the first round. So let me draw this. It's quite intuitive if you carefully follow this. AD 0. So now let me put down the formula as well, just for exposition. AD is basically equal to I plus, well, C plus I plus G plus NX, yeah. So that G increased by 20 billion, which means there's a shift by 20 million. So that gives us 81. That's the first round. That's a shift. Second round now. Out of the 20 billion injected in the economy, we consume part of it. So that's going to be MPC then times by 20 billion. So that's 80% here. 80% of 20 billion is 16 billion. So let's say we received this 20 billion as income and we then saved 4 billion of it and then, or kept 4 billion withdrawn from economy and then spend 16 billion in the economy. So in the second round, C increases now. Consumption increases by 16 billion. So another shift. Another smaller shift, but it's actually another shift here. 82. That consumption, remember, it becomes income of sellers of goods and services to us. Yeah, shops and all these businesses receive this money. And someone's income is someone's expenditure, someone's expenditure is others' income. So our consumption expenditure becomes someone's income, and then we then receive wages. It comes back to us in about 16 billion, in the form of about around about 16 billion. That 16 billion will be partly saved, partly spent now. So we will then multiply that by another 80%. So because 80% of 16 billion will be spent, other will be basically saved. So that's gonna be how much will that be then at 80%? So 4.8 times 16 gives us about 12.8 billion. So that's a smaller amount, isn't it? So each time now that's another consumption round, yeah? It shifts again AD. So AD keeps shifting to the right until this change in Y becomes 0 basically. Or change in basically consumption becomes 0, I should say. In this case it's consumption that's changing, but it could also be investment as well. So eventually we settle right here. This is our last AD. This is our last ADN, whatever that thing. So given the price level, so the distance between this, so between this point and this point is basically now is the change in income. So this thing here is basically 100 billion. So the difference between this income and this income here is 100 billion. You see that? 20 billion becomes 100 billion eventually increase in GDP. So here with this example we have MPC, marginal preference to consume, to be 0.5. So in other words, every pound we receive as income will be spent. Half of it will be spent, half of it will be saved, let's say. Let's say the injection, the G here, so government, let's say, decided to inject 160 million into the economy. So that delta J stands for injection, remember, is that much. Income then increased by 160 million, initial increase. From that income we spend 50%. So consume 50%, withdraw 50%, which is 80. Now once we consume 50%, 80 pounds will become someone's income, yeah? We spend that 50%. And that 80 million is then again either saved partly, or in other words, I should say part of it is saved, 40 billion, and part of it is, part of it is spent on consumption, part of it is saved. Now that the part that's been spent becomes now someone's income. They will spend half of it. 50% of the income is expenditure, and that expenditure becomes income, and 50% of that next expenditure level goes on until consumption becomes zero. Notice, in the end, our income is now 320 million more than what it was in the beginning. So this is basically over time. Over time, our income basically increasing. As the time goes to infinity, I should say this is time, over time we will sort of basically be spending or consuming and receiving income and consuming and receiving income, so we'll accumulate that much of income. So in other words, the original AD curve here at the given point here at the price level will move somewhere here, right? So this distance here is basically now from y1 to y2 is 320 million. This is how much AD changed or income changed as the successive shifts happened and eventually settled at this point. Right, so that's the idea here. So with the multiplier effect, so fiscal policy is a very effective tool to affect AD. Right. Now this is just additional information. Please read it. I'll move on. If let's say we want to be here, this is our potential output, but we are here. We are basically spending less. Less. We would like to be here. We would like to be here, and we would like to spend that much. But we are currently here. So what happens is that to push the income to the full output level, we can inject that 20 billion. Yeah, this is the example I gave you earlier. So it's from a different point of view, using a different graph. So this change in G could be 20 billion. But eventually that gives us 5 times more income. So that by shifting this AD curve upwards, yeah, to this point, we are actually shifting the Y1 towards YF as well. Yeah? It's just an example of how we can plug this deflationary gap. This is a recessionary gap. This difference here is basically what we call a recessionary gap.